All right, so comparables. So they so comparables are used to value companies based on primarily on multiples. The most common multiple is price earnings ratio. There's also enterprise value ratios. The price earnings ratio is calculated as the current price per stock divided by the annual earnings per share. You can get this information in the Wall Street Journal. It's some some websites actually have forward and trailing earnings per share based on trailing would be based on historical, forward would be based on projected. So PE ratio, just price per share divided by earnings per share. Enterprise value ratio, sort of a little different. PE ratio focuses on equity. So, but the enterprise value ratio allows us to value the firm using debt and equity. So we use the enterprise value, which is the market value of equity plus the market value of debt minus cash. So like PE, we compare the value to a measure of earnings from a firm level. This is we use EBITDA, earnings before interest, taxes, depreciation, and amortization. The EBITDA represents a measure of total firm cash flow. So the enterprise value ratio, enterprise value divided by EBITDA. So we can also value stocks based on using free cash flow. So in chapters 5 and 6, we learned about the value of a project. Using calculating the NPV, discounting the value of the cash flows it generates, and comparing those to the cost of the project. The firm value is the consolidated present value of the cash flow of all its projects. Next we move on to stock markets. We have two types of stock markets: dealer markets and broker markets. The NYSE is an example of a dealer market. You have dealers there that are ready to buy or sell a stock at any time. Those are called designated market makers. The way the NYSE works, the NYSE is an auction market. So the orders are placed. So the buy order would be any buy order would be applied to the lowest price available of all the other offers to sell. All the asks and then sell orders would be applied to the highest bid prices. So it's theoretically a more efficient market. A broker market is brokers basically match buyers and sellers. So it's also a slightly less precise measure, but there's only slight efficient differences. So market order is simply you specify the ticker, the name of the ticker of the stock, and the quantity of the stock you want. You get immediate execution at the best available price. Market buy will be executed at the lowest ask. Market sell will be executed at the highest bid. Limit orders, you specify the quantity, the ticker, and quantity and price. The order is executed only if the trade can be made at the limit price or better. So a limit buy can only be executed at the limit price or lower. So if you put in a limit buy, you're saying I'll buy it if it's if it's at 80. You say put in a limit buy for a stock. excuse me, at $80 per share, it will only be executed at 80 or lower. For example, on the other side, if it was put a limit sell order in at 80, so it could only be executed at the limit price or higher. Stop orders. So a stop order, the stop price is a trigger or activation point. So if the stop price is reached or passed, the order becomes a market order and to be executed at the best available price. You're not guaranteed of receiving that price. The market could be moving so fast that you may not receive that price. So the risk price suddenly plummets or rises, and the execution price is much different than expected. So, Nasdaq is not a physical exchange. It's a computer-based quotation system. It is a market of brokers. They do have multiple market makers, electronic communication network where the trades are made and so forth. The 3 levels of information. So timely and accurate quotes freely available. Level 1. Level 2, view quotes from all Nasdaq market makers. You pay a fee for those. And level 3, view and update market quotes. Those are available to market makers only. A large portion of technology stocks are listed on the Nasdaq stock. We noticed recently the Nasdaq stock has been very, very volatile. It's actually done quite well this year. Okay, we'll start the next slide with the stock market reporting and conclude the chapter.